All right, hello everyone to the beginning of chapter 3. So it's important to kind of note how exactly everything is structured. So a lot of chapter 1 was, well, what is an investment bank as a cohesive unit? Not necessarily the service of investment banking, which remember I talked about how that was different from, well, an investment bank as a whole. Remember, investment banks are profit-making behemoths. They have a range of services, whether it be the sale of securities, or whether it be sales and trading, or whether it be investment banking in and of itself. Right? We also talked about, well, how an investment bank was structured. We talked about how there were regional banks, there were middle market banks, there were boutique banks, there were bulge bracket banks. We talked about the inner separation of an investment bank, how there's a back office, how there's a middle office, and how there's a front office, and so on. You kind of got a well-rounded picture of what an investment bank was in Unit 1. In Unit 2, we talked all about, well, kind of the basic services that delineate what investment banking is. So we talked about mergers and acquisitions. We talked about the initial public offering / capital markets. We talked about leverage buyouts and private equity. Those are all things that are composed within investment banking as a service. And remember, investment banking is a service that investment banks do provide. So chapter 3 is going to be all about that capital markets / IPO section. Chapter 4 is going to be all about mergers and acquisitions. And chapter 5 is going to be all about leveraged buyouts and private equity. Guys, this is so applicable to everything that we're doing daily, right? Reddit is going to IPO in March. That's interesting. That's something that you guys use on a daily basis. And, you know, it also leads to questions like, well, is Reddit now, in order to make more money, in order to appease investors like you and me, going to install subscriptions within the app? Because at the end of the day, everything does come down to money. Maybe you don't like what happened with Twitter, where people could pay for like blue check marks, or pay for other kinds of services. Some similar things could possibly happen to Reddit, and it all kind of surrounds the IPO. Another interesting thing that's going on that we can talk about later in Unit 4, when you guys understand it, is the possible hostile takeover that may be ensued by Macy's parent company, and also the undervaluation of Macy's as a business, right? The company that's trying to acquire Macy's is trying to acquire them for around $5.8 billion. But Macy argues, no, I should be worth around $11 billion because of all of the physical assets that I do have. And because of Macy's disagreement in this takeover, a hostile takeover may be ensued. And that's something to read about, right? Because that's what could cause fluctuations in Macy's stock price. Another big merger and acquisitions news story. What happened with Spirit Airlines, and I believe it was United or Delta, one or the other. They were about to merge, but the Department of Justice said, no, this may go against some antitrust laws. This may be an antitrust violation. What happened to Spirit Airlines stock? It plummeted by 50%. That's an insane amount. Spirit Airlines might go bankrupt just because of that, and that's, I'm sure, an airline that all of you guys have used. It's one of the most renowned budget airlines within America. So again, mergers and acquisitions, initial public offerings play a central role in today's time, and you know, it's this club that's letting you talk about it. So let's just get started. This is the attendance form. If you can scan it, just do that again. Thank you. And then this is one more form, so we're gonna try and get our club within the yearbook. So scan this and then just fill it out on your own time. It may take 5 to 10 minutes to fill out, but it's just important information the yearbook team might want. And I'll leave this up for the duration of all of chapter 3. So, and then this is of course the website. After this meeting concludes, I'm going to go to the 3.2 module and give you guys a bit of a summary as to what may go on there. And let's just get started. When companies turn to IPOs, guys, what does an IPO stand for really quick? Exactly. That's what it is, right? And what we, in a nutshell, need to understand is a company goes and gets an IPO with the help of an investment bank when it wants to go public. So a private company becomes a public company when they IPO. And the big important picture there is now their stock is available to the public, like me and you. When they become public, their stock is available on public stock markets like the NASDAQ or the New York Stock Exchange. If they didn't IPO, you can buy it. So when a company becomes big enough and a large audience is ready to buy a piece of them, it is often time to consider that infamous initial public offering. When a company goes public, it creates shares of itself that the general public can buy. A company will decide to go public via an IPO when, well, okay, these are the three. So what we must understand about an IPO is that it's kind of that last resort after these three options to raise money. Initial public offerings will raise money for companies, right? Because what are companies giving up? They're giving up equity or shares of themselves that the public can buy in exchange for money. So let's say that these three things don't work out, that's usually what they go to. So the first of them being bonds become too expensive. So private companies usually don't have a track record for performance. They're a risky investment. And because of this, when they issue bonds, they will generally have to issue bonds with a really high interest rate. Guys, is private company information easy to find? Do you guys remember the answer to that? Not as easy to find. You're not going to be able to find a lot of their information on Edgar or the SEC's filing database. And because of that, when something is a bit riskier, it usually comes with higher rewards. So when they when they give out bonds for the public to buy, well, the public's going to say, okay, I'll buy your bond, but it needs to have a high interest rate. I want to make more money on it because, well, there's more risk on the line. I don't know if your business is going to flop 360 over the next day, right? Also, private companies have uncertain cash flow, which is somewhat linked to this. They aren't entirely sure whether they can pay routine high interest rates. I mean, there are so many reasons for this. A lot of the times, some private companies may be really niche, maybe really small. They might not be able to afford, like, let's say something within their supply chain goes wrong. Some kind of apparatus gets destroyed. They may not be able to afford to, well, repair that apparatus, or because it's a niche company, let's say they're working on some kind of patented product, they might not have the resources at that time to repair that, patented apparatus as fast as possible. So there are a ton of reasons as to why private companies do have somewhat uncertain cash flow, but that's one of the reasons why bonds may become too expensive for them and they need to issue in an initial public offering. Another one is bank loans become too expensive. This one's kind of intuitive, right? The bigger your company gets, the more money you're going to need in order to, well, expand that company, in order to invest in more capital goods. That's one of those things businesses are going to reinvest their profits in. Well, it becomes more costly because you have bigger loans and you have that same interest rate. And as we know, interest can kill companies. It can kill people too. It's a double-edged sword, leverage, debt, so on. And we talked about that. Now, venture capital. So the first one assumes that you already haven't, this number one here, assumes that you already haven't ensued in that venture capital route. So obtaining money from venture capital firms is great, but it comes at a big cost. So what do venture capital firms do? Well, let's say you're a small business. Let's say Reed has a business. He sells books, right? He's gonna go to this venture capital firm because he's exhausted other sources of revenue. And he's gonna say, hey, look, I need $10 million, all right? What's the venture capital firm gonna do? They're gonna say, hey, yeah, sure, we'll give you $10 million, but you need to give us 30% of equity within your company. AKA, you need to give us 30% ownership within your company. So what's the exchange here? Equity for money. And venture capital firms want a lot of that equity. And a lot of companies don't want to give up that much equity. They don't know how much their company could be worth in the future, right? So one, right here, maybe that small company rejects that initially and just says, you know what, we're gonna IPO. The second would be liquidity. This assumes that you already have a venture capital firm invested within you. Does anyone remember what the word liquidity means? What's up, Shane?
Like how easily you can turn your company to money?
It's how, yeah, exactly. It's how fast you can turn an asset to cash. So guys, what's more liquid, a house or a stock?
A stock.
Exactly. You can find a buyer for a stock in almost minutes, right? Turn that into cash. So many investors within private companies don't have many sources to which they can sell their stock, right? Most of us cannot buy private company stock. We can only buy stock from public companies that have listed their stock on the New York Stock Exchange, NASDAQ, so on and so forth. In order to buy a private company stock, you may need to actually know the owner of that company, or you may need to be an accredited investor in some kind of high influence circle, so on and so forth. So a lot of these investors who can't really find a buyer for their stock because they're in those high influence circles, so on and so forth, will pressure that existing company to go public so that, well, they can go liquid, right? They can liquidate the current stock they have and get cash for it. So hopefully all of that makes sense. But again, big picture here is IPO is usually that last resort. I'm sorry about that. Yep.
All right, so being the prime candidate for an IPO. For an IPO to sell its stock, they usually need to have a few things to attract investors. And these are a strong competitive advantage, speedy growth, and high demand. So first of all, we got strong competitive advantage. This is basically when a company makes sure its industry or product it creates is protected and in an industry that has a strong competitive advantage. And this is used with their high barrier to entry. A high barrier of entry is when it's hard for competitors or new companies to come into your industry and compete with you. So the example we have here is USPS. Since USPS is like a ground shipping company, obviously it's hard for a competitor to compete with USPS because they need trucks, workers to drive those trucks, boxes, factories, etc. Nextly, we have speedy growth. So if investors are going to invest in the company, they want a quick return on their investment so they can make a profit. So they instead want a piece of a company with explosive growth rather than like a bond. To do this, they examine the growth rate of the companies they invest in. And lastly, we have high demand industry. So basically, if an investor is going to invest in your company, they want to make sure that the company they're investing in is in an industry that has high demand. So when they go private, there may be more investors readily available to buy that company's stock. So like internet companies in the late 90s, when the internet was becoming mainstream, a lot of investors invested in internet stock.
That's the next slide.
Oh.
It's like there. On the bottom. Find the laptop.
Okay, so the rule of internet IPOs in the market. So this is just a quick example of internet companies going IPO. So in 1998, 12.4% of IPOs of that year were from internet companies. 1999, 1 year later, it jumped up to 54%. And then in 2000, around the same, 37.5%. So this is just an example of like a booming industry. Enjoying when people are people want to get in on an industry, they're going to go IPO so they can have more opportunities.
Can I take the mic?
Oh yeah.
So guys, it's important to remember, well, one, does anyone know the exact range of dates of the dot-com bubble? 1995 to 2000. Just an interesting thing to note, especially in this context, right? Because what we're talking about here are industries that experience high demand or a boom. What happened as a result of the dot-com bubble, right? That bubble bursted. So it's also important to note that with a lot of temporary booms, there will be a prolonged bust afterwards. So especially if you guys are individual investors, make sure that you know the repercussions of something being in high demand for so long. It'll usually drop down low.
Okay, so the prospectus. So in simple words, a prospectus is just a financial report. So along with a financial report, inside of financial reports is a financial statement. So an example of a financial statement could just be like a balance sheet or an income statement or something like that. So the prospectus is a document that companies must produce if they're going to IPO. It lists all the financial details, risks, and opportunities of a company. So one important thing to remember is that when a company, any security that a company has must require a prospectus. So not only stocks, they also need a prospectus for things like bonds or anything like that. So this is one of the major tasks that investment bankers are tasked with when companies go public.
Yeah, and you know, what's a word for securities that is synonymous to it? Investments. So whenever you think of the word securities, just remember investments. Typical investments you think of, like Reed did mention, were stocks, bonds. Others could be preferred shares, convertible bonds, and the list really goes on. There are like an infinite number of investments. And it's important to note that whenever a company wants to sell one of these investments to the public in order to make money for itself, they always have to issue a prospectus. So remember, the prospectus is that financial report that is always required whenever a company takes some kind of security of its domain to the public to sell. And also remember, does anyone remember the two other financial reports I talked about alongside the prospectus in 1.3? 10K and 10Q. 10Q being the quarterly report for a company, and 10K being the annual report for a company. And it's equally as important to remember that financial statements are found within financial reports. So within the prospectus, we're going to look at things like the income statement, the balance sheet, the statement of cash flows, and so on. And we're going to talk about that a bit more later.
Okay, and these are just the components of a prospectus. This isn't in order, but this is just all the things that a prospectus has in it. It has a summary, it has risk factors, industry data and other metrics, use of proceeds, capitalization, financial data, management's discussion and analysis of financial condition, business management, executive pay, related party transactions, principal and selling shareholders, and underwriting and legal matters. So these are just all things that people will have access to look at and will ultimately help them decide whether it'll be a profitable investment or not.
Exactly. Thank you, Reed. All right. So now it's time to talk a bit about the components of the prospectus. So the first is kind of the most important. However, I don't believe this is in order of how you may see things within the prospectus. It's the summary. This contains the main details investors are looking at, especially those companies' general objectives. What does the company want from this deal, from it releasing these securities to the public? Why does the company wish to sell stock, or maybe it be bonds, and so on? And these reasons can get really important, right? Is it because they just want investors to liquidate? Or does the CEO just want to sell its stock? Or is it because they have some kind of factory that they want to buy new machines for so that they can expand their product line? These are very important reasons that you must be able to differentiate between. And with this, investors can also gauge the size of a company's target market. Target markets are so important. If you guys ever watch Shark Tank, one of the biggest questions sharks will always ask entrepreneurs, budding entrepreneurs, is how big is your target market? And it's after this question, especially if the target market is small, that some sharks may reserve their foot off of the table. They'll just step off of it. So you want to make sure that you're in a big target market. And also, number two, what else will be found within the summary are the amount of shares a company plans to sell in their respective prices. So, those technical details, but of course, equally as important, because this is what determines your market capitalization, right? Market capitalization is kind of how companies, or public companies at least, are valued. Does anyone know what company has the biggest market cap right now? Microsoft just surpassed them. That's why I was going to ask that. So, it's pretty crazy because I believe Apple was valued at like 2 trillion something, and now you have another company that's valued a bit over that. I think they're still battling for the seat right now. If I'm incorrect, I need to search that up and I'll let you guys know next meeting. But yeah, market caps are important, and you can figure out the market cap of this company by looking at number 2. So risk factors, right? This contains all of the risks that this company may have with this prospectus. This is kind of where they prepare that I told you so defense for those investors. Industry data and other metrics. This contains information about the industry a particular company is in. Hey, is this a booming industry? Well, if it is, could it possibly bust? Who knows, right? Profits are relative to the industry a company is in. The profitability of an industry can kind of determine the value of a company, which is kind of self-explanatory. Financial measures that are important within the industry, and how the company that is going public compares to other companies within that sector. Yeah, what's up, Reed?
So how you were talking about how the tech industry was booming from like 1995 to 2000 and
yeah.
kind of busted. So would you say that's starting to move
again?
Can it do it multiple times?
Definitely, right? It's not just as though it has one period where it experiences absolute tranquility, absolute bliss, and then the rest is the dark ages, right? With innovations in technology, there might be multiple booms. Like, for example, a recent one would be NFTs and cryptocurrency. What happened there, right? You can categorize that within technology, or at least technological investments that boomed, and of course with that boom, there was a bust that did follow. And for general boom and bust cycles, you guys are gonna learn all about that in APUSH. So make sure you keep track of that, because that can be realistically applied to the world of investment banking. And the rest, Shannon, you want to take it? Okay.
Oh, where am I at?
Use of proceeds.
Cool. So, use of proceeds, this is basically how the IPO is going to use the money. An example is pay off debt, purchase another company, or allow employees to sell their shares for money for themselves. And if money is not being raised, it's not being used by the company, investors might get suspicious, and if excessive stock is sold by the CEO, investors might even get more suspicious, which might make them sell their investment. Going on, we have capitalization. This contains different ways that a company uses to raise money for themselves, so stocks, bank loans, bonds, etc. And then we have financial data, so yeah, just all the company's financial statements, like the prospectus that we've talked about a million times. Balance sheet, income statement, statement of cash flows, everything like that. And then lastly, we have management's discussion and analysis of financial condition, or MD&A. This is a really popular word you might hear a lot, and it contains a description of each part within a company's financial statement. So basically, by reading this MD&A, you can get a lot of information about the financial history and growth of a company. They're written by the management team and a company alongside investment banks.
Right, thank you.
Alright, so we got the first half of the prospectus, the parts of the prospectus. Now this is the second half, just as important, guys. Check out business. Contains business information, the reason of the company's existence, and the products and services itself. So obviously, if you're going to invest in a business, you're going to release your business for stocks. You want to know what kind of company it is, right? You want to know what it does. Beyblades. You're not going to make computers if you're a Beyblade. You know what I'm saying? Management contains lists of top management: the chief operating officer, the chief operating officer, the chief operating officer. I think that should say executive officer, the first one, the CEO.
It should.
Yeah. The chief operating officer, the chief financial officer, and other members of the board of directors. And that's just like the overruling, the top executives of the company that control most of the decisions. Oftentimes, the section will also include short biographies of the management members, like just a little description of what they do. Like executive pay contains the amount that the management is paid. A table includes an executive salary, stock awards, bonus, and all of the forms of payment. Executive pay does not cap his or her salary. It is simply one form of his or her payment. Regulators such as the SEC have also regulated some of that stuff.
And it's really important to note just one thing, right? The difference between compensation and salary. If you guys don't already know it, right, your baseline salary may be $60,000 a year. For investment bankers, let's say you're an analyst, your baseline salary might be $90,000 to $100,000 a year. And then, with your total compensation, that includes your bonus, it includes stock, and so on. So now, with that $100,000 baseline salary, the total compensation, let's say a 30% bonus, you could be making $30,000 on top of that, so $130,000 in total. Then maybe you get $10,000 in stocks, so $140,000, and so on. So regardless of what job you work at, it's important to look at total compensation, not just baseline salary.
All right, so next we have the related party transactions. So this contains the information regarding the complex business relationships. So it's like you have to list the sources of the financing, and also so if you have these like your family members, your friends, if they're still tied to your company, then they're going to be listed in this section. Next, we have the principal and selling shareholders. So this is going to be everyone that's selling you shares. So, for example, if Joe Burrow's out there selling you shares, you're going to have to put him on there and say everything about him. He's on the Bengals. Wasn't very impressive in fantasy. You got to put all that on there. But if the company is private, they don't need to disclose it. They don't like their investors or anything. Underwriting. This is the list of all investment bankers and advisors that assisted bringing your company public. So that's going to be us. And then the legal matters contains any pending lawsuits against the company. So that's pretty important. You got to include how serious you think the lawsuit is. And young companies got to watch out because they're usually going to be the targets of lawsuits.
Exactly. And does anyone remember what the word underwriting means? Taking a financial risk for a fee. Why? Because investment banks are saying to these companies, hey, look, I'm going to buy the amount of stock you wish to sell to the public market, and I'm going to sell it to institutional investors on the primary market. Well, what if those institutional investors don't want to buy all of that stock? Well, that's where the risk comes in, right? And that's why investment